If you would have told someone that we'd get that America First policy, that by the end of 2024, we'd have 75 and now 100 basis points of cut with December once we get that, you would have said, okay, it's going to be a huge month for small caps. Small caps will be off like a rocket. You saw that in the beginning post-election. But since then, the rally has really started to concentrate again. It's been the Mag 7. It's been the tech players. Breadth has been negative over the past 8 trading days. Is this a sign that the small cap trade might not play out as expected in 2025?
No, I don't think so. I think what's really happening is that investors are being very active in terms of their exposures, and there's definitely some trading that's starting to take place right now, and they're chasing the near-term laggards, and they're selling some of the near-term winners. And I think that's what happened after the election. You've seen this great month for small caps. You've seen a great month for regional banks and financials, and then you took a pause with that, and you look to big tech, for example, and the fact that it's lagged, the semiconductors, software, all of that right now is having a catch-up moment. So I think it's about a series of those rotations. But no, I don't think investors have given up on the fact that it's going to be domestic economy first in 2025, domestic revenues first. But I would probably broaden out the small cap trade and just say prioritize companies that have a high share of domestic revenues, whether they're small, medium, or large. And if we are going to end up with an environment, I call plenty of wildcards in 2025, that we talk about tariffs before we talk about tax cuts, that probably does have a few risk-off moments. So maybe small caps is not the only place you want to be. You want to be in a high share of domestic revenue companies that maybe have the quality tilt to them as well.
If you're worried about tariffs and domestic policy, is it useful to stock pick depending on what CEO is reaching out to Donald Trump, depending on who's down at Mar-a-Lago?
Well, that might be a factor, yes. So some managers will choose to incorporate into their models. But I do think next year is all about the dispersion of sectors, factors in different stocks. And, I think you want to be positioned in parts of the economy that are growing and also have a high share of domestic revenues. Obviously, engagement with the administration is also a good thing. So that's why we're looking at financials, we're looking at regionals, we're looking at utilities. We're also looking at software stocks, for example, relative to the semiconductor stocks. And, speaking of chasing laggards, right? Semiconductors have had a stellar year in 2024 and also 2023, but I think some rotation into the domestically tilted software makes a lot of sense now.
Well, building on Danny's point, I guess the question is, do you expect this administration to do what they've done in the prior when they were in power, which was for some companies, you're going to have to offer carve-outs?
Yeah, I think it's definitely a possibility. And, Anne-Marie, I would say, the title of our outlook for next year is solid underpinnings for the U.S. economy and plenty of wild cards. And the truth is, we just don't know which wild cards we're going to get. And the wild cards that I'm thinking about are tariffs and taxes and budget deficits, as well as the direction of Fed policy and also the direction of big tech regulation. And the truth is, we might get an administration that imposes the unilateral universal tariff, or maybe they have a threat of it, or maybe there's an agreement that actually gets negotiated in the process of it and does it very quickly. We don't actually know what the ultimate outcome is going to be. And so that's why for investors, I think it's really important to stay pro-risk, to stay pro-growth, to stay pro, solid economic environment, but just recognize that the range of outcomes is going to be wider.